to our channel. This is Bhushan and this is the second video of the beginner series. In this video, we will discuss basics about options, the jargon's used while trading options. Although I wouldn't recommend to trade in option without having proper knowledge of price action. What you can do is you can go through our first video where we discuss trading in equity, managing a risk properly in equity. Do that for some time and then come to option trading. Option may look so fancy from outside that your investment getting 3x, 4x returns in a single day, one option price getting 3x, 4x times in a single day. There are similar risks involved where the major reason for blowing any account in the market is F&O trading. Coming to market without having proper knowledge about option trading is the basic mistake every trader makes. Even we made that mistake and we paid the price. We may get lucky for a couple of sessions where we earn good profit, but eventually what happens is you give back that market to the profit to the market, potato, tomato. If you still want to trade in option, what you can do is you can trade with virtual money, have virtual trading account. There are so many apps which provide Sensible, Opstra. You can trade with a virtual money, do it for some time, have a proper learning curve, and then come with real money to the market. Okay, so let's begin. So what are options? Options were mainly introduced as a hedging tool. What do I mean by that? I'll just give you one quick example. I'll give a lot of examples today so that it will help to understand. Anyways, suppose this is a resistance and this is a support. Okay, this is a Nifty 1-day chart and you have a portfolio in the market of XYZ amount from here. Okay, you bought it here and now you are getting good profits. So it came here, it gave a pullback again, next time it came here. So this will act as a resistance, right? So you have a short-term view that market can pull back from here and go till the support. Support is this level. But you don't want to lose on your investment ka profit. Okay. So for this purpose exactly options were introduced. Now what options do you have? You can sell calls here or you can buy a put here. So what it will do is from the short-term perspective, your investments may go down. Okay. But the options you bought here, you can gain from that. So the amount you're losing from your investments, you can get it from options, right? Similar concept. If market is at the support, you expect it to have a pullback from here. What you can do here is, you can also gain from your investments, one thing. But second thing, you can sell puts here. What it will do is, it will give you additional profit along with your investments. So for this purpose exactly, options were introduced. But if somebody asks me, what are options? Like, ये सब तो textbook definition है, this is fine, hedging purpose and all, but options है क्या in the real time? Again, I'll give you one example which I read it somewhere, but just for understanding better. Suppose there are two people, Mr. A and Mr. B. Mr. A owns the land. The cost of that land as of now is 5 lakhs rupees. Okay, there is a rumored project that a highway may pass from here. Okay, A and B. So if highway is constructed here, the price of the land will go up, obviously. Okay, so it is just rumor. As of now, it is not in any practical construction or anything. So after 6 months, 3 things can happen. The highway is already constructed. The rumor turns out to be false. Highway is constructed. Rumor turns out to be false, and there is still a rumor that exists that highway is under construction, and no change happens. Now B wants to buy it. A is adamant on selling it. So B wants to play it safe. So what he proposes to A is, I'll give you 1 lakh today, and after 6 months, I'll decide whether to buy it or not. Okay. So now this 1 lakh he pays to A. So what can happen after 6 months? After 6 months, these 3 things can happen. Like the highway is constructed, the rumor is still there, and the highway is not constructed. Rumor turns out to be false, and the price of the land goes down. Okay. So we will consider all the 3 scenarios after 6 months. So after 6 months, suppose highway is constructed. This is the land and this is the highway. The price of the land shoots up to 10 lakh. Okay. Now he paid him 1 lakh and the prices is now 10 lakh. In that case, Mr. B will exercise his legal right to purchase the land. So he'll get the same land at 5 lakh rupees because the deal was already signed before 6 months. So who is in profit here? Mr. B. Okay, because he is getting the 10 lakh ka land in 5 lakhs. Second thing that can happen, the rumor still exists and the prices of land remains the same, and that is 5 lakh. After 6 months, B can decide whether to buy the land or to just chuck it because the prices are the same and rumors still exist. So what will happen to B? He'll lose on the 1 lakh rupee which he gave as a premium to Mr. A. Okay, he loses on 1 lakh rupee. Third thing, what can happen is the price of the land goes to 3 lakhs rupees because this turned out to be a rumor and the prices went down. So now what can happen is B, obviously he'll choose not to buy it because it was not a mandate on B that he has to buy it, because he just paid a premium and he'll decide after 6 months whether to buy it. So he'll not buy it. If we consider B's perspective, he is profitable in one scenario. Now consider A's perspective. In this case, A will get 1 lakh rupees extra, okay, which B gave him to him at the initial sign at the start of the agreement. In this case, A will get 1 lakh. Okay, so in this case also A will get 1 lakh extra. So net profit of A is here is 4 lakh loss. Here it's constant, it's 1 lakh profit, and here it's just 1 lakh loss because he's getting 4 lakhs because 3 plus 1 is 4 and the price of the land was 5 lakh. So this 1 lakh is the premium. Let's compare it to the market. This 1 lakh is the premium. So these are the options prices. Okay. Buyer, Mr. B, is not obligated to buy the land after 6 months. He can choose it to buy it or he can just ignore if the prices go against him. While on the contrary, Mr. A has to provide the land if B exercises his right to buy it. Simple. Let's not make it complicated. Simple. A has to give it to the B अगर B ने बोला मुझे land चाहिए after 6 months. In what case he'll do it? अगर land का price will go up. Just in one case. Okay. In other two cases, B बोलेगा मुझे land नहीं चाहिए because prices is still the same, rumor is still the same. He'll choose to just leave that 1 lakh, 1 lakh का नुकसान लेगा, but he don't want to buy it for additional 5 lakhs because he wants to play it safe. He can go to some other place and buy some other land. But अगर land का prices goes down, B will straight away choose not to buy it. It's not a mandate on B's side that he'll buy the land. In the similar way. So this, if you compare it to market, you will understand it better. So in the future, while explaining the option, I'll just take this example, Mr. A and Mr. B. Just keep that in mind. Okay, let's continue. So all this is fine. Real life में options कैसे रहते हैं, कैसे work करते हैं and all. Now let's connect this information with the market. So as of now, there are 3 indexes जिसमें options present है. First is Nifty 50, second is Bank Nifty, and third is Fin Nifty. Okay. So option इनका derivative product है. Okay, future and option. What does it mean? It means कि whenever Nifty will move, it will affect future and option of the Nifty. So they derive their value from Nifty. Similarly, Bank Nifty option will derive its value from Bank Nifty. Okay, so it means whenever Bank Nifty will move, the succeeding उसके future and option will move. Okay, similar case in Nifty का future and option, and Nifty will move when its constituents like Nifty 50 के 50 stocks, it will move. Similarly, Bank Nifty के जो banking constituents है, it will depend on those stocks. Similarly, Fin Nifty के जो banking plus insurance constituent है, उसके ऊपर it will move, and Fin Nifty move किया तो उसके ऊपर its future and option will move. So these things are connected. So that's why we called it derivative product, because they derive the value from the succeeding जो है where it is connected. Okay. So now Nifty में you get 50 के strikes पे options. So just a second. Yeah. So यहाँ पे price Nifty का 18,100. So you get 18,150, 18,200, 18,250, 18,300 like this. Similarly, in Bank Nifty you get a difference for 100. So now Bank Nifty is at 42,580 So we'll get 42,600, 42,700, 42,800. Similarly, Fin Nifty mein you get it at the distance of 50. So every succeeding 50 will have its option. So Fin Nifty is going around 18,730. So 18,750, 18,800, 18,950, something like this. Okay. So what are these? These are the strike prices. So जो index है उसके 50-50 के difference में strike prices पे we will get the options. Okay. So now let's study the options. So there are two types of options. Everybody knows that. The first is call and the second is put. Okay. If we are buying a call option, that means we are collecting the premium. In the example where Mr. B paid rupees 1 lakh as a premium to hold the land. Similarly, this is example of buying a premium. So we are giving the premium. Okay. In the put, if we buy, our view is downside. Okay. So now selling, our view is, if we are selling a call option, our view is downside. And if we are selling one put option, our view is upside. Buying means we are giving the premium. Selling means we are collecting the premium. Selling means in the example where Mr. A collected 1 lakh rupees from B. Okay. So similarly, buying means Mr. B paid 1 lakh rupees to Mr. A from that example. Be very clear about these directions because it will be used in future a lot. So now that we have discussed this, let's discuss what is moneyness of an option. So I made this just for ease of understanding. So this is a spot price. Spot price means where the Nifty is currently as of now. And these are the strike prices. Strike prices is basically the options we are selecting. As I mentioned, in Nifty there are options present on 50 strikes. So these are the strike prices. One thing we need to know is what is intrinsic value. So call option intrinsic value is this spot price minus this strike price. So it cannot be negative. What do I mean by it cannot be negative? So all the options where the subtraction comes negative, that means in these options there cannot be any intrinsic value component in their premiums. So this 18,000 call option will have a premium, suppose 50 rupees. This premium is equal to the 1 lakh Mr. B paid to Mr. A. Okay, so consider it as a premium. So this will have one premium. This will go on reducing as we go further from the strike price. So this will have around, consider 30. This will have around 20. This will have around 10. So as we go further from the spot, the premium will obviously reduce and they will have no intrinsic value. The intrinsic value considered will be 0. So now what is ATM? At the money. So if this difference is 0, that means if we are purchasing the same option which is at the strike, that means we are purchasing ATM at the money. Okay. And as we further go upside for call option, where we get negative intrinsic value. Just for ease of understanding, I am mentioning where we get negative intrinsic value. Those are OTM. Okay. So the premium goes on reducing as we go further from the market. And if we go closer to the market, so basically 18,000, if we go select the strike where 17,950, this is we get positive intrinsic value. That means we are in the money. So all the premiums around this level we have will have one intrinsic value. So suppose this is 50 in the money, so this will have a premium around 85 rupees. Consider just an example. This will have a premium around 100 rupees. So there will be one component of intrinsic value and one component of extrinsic value. As of now, I won't be explaining extrinsic value because we will cover that in the next video, which will be option Greeks. Just consider, if we are considering intrinsic value, If it's coming positive, that means we are in the money. Simple. I'll again explain what is OTM, ATM and ITM. Okay, in the simple language, this is spot price. If we go for call option, our view is upside, right? So if we go further from the market in the direction where our view is, those are OTM strikes. So these are OTM strike. This is at the money strike because we are purchasing the same option where the market is, and this will be in the money. ITM, OTM, this is sorry ATM, my bad. This is ATM and this is OTM. Cool. Similar will be the case with put option, but it will be exactly opposite because we will be considering downside, right? So I'll just draw that and connect. Similar thing I did with put options. So consider the strike is 18,000 and these are all the options we are selecting. These are the strike price, okay, and this is the spot price. So now put option intrinsic value is strike minus spot. For call option we had spot minus strike. Now we have this strike prices minus the spot prices. So suppose we are selecting this put where 17,950 minus this value comes down to negative 50. Okay, so all the options which have negative intrinsic value will be OTM. Okay, so these two will be OTM, right? If the value comes down to 0, that means it is at ATM. And if the value comes out to be positive, that means we are in the money. Simple. So the premiums will be like OTM will have obviously less premium. So consider this as suppose 50. This will be 65. This will be 80. This will be 95, 105, and so on, so on. So premium will decrease as we go from in the money to OTM. Okay. So this what is exactly why we select in the money, at the money and OTM. We will be covering it in next chapter. This is just to understand what is ATM, what is OTM, what is intrinsic value and everything. Okay. So considering market as 18,000, 18,050 put will be in the money. Considering market at 18,000, the 17,950 will be out of the money. But now we know that market is continuously moving. So suppose market goes down from here, market comes to this level, 750. So for that, this strike will be now ATM. And this will be ITM, in the money. It's a little confusing, but once you get hang of it, it will be quite simple for you to understand further references. Okay, just try to remember these things. What is OTM, what is ATM, and what is in the money, because it has a lot of relevance on selecting the strike prices. Fine. So I guess everything is covered for basics of options. So that's it for this video. In the next video we will get little deeper into these concepts. Mostly what are option Greeks, what is intrinsic and extrinsic value of a premium, how to calculate the premiums, option chain, the payoff graph and everything. So for that you will need a little understanding of these concepts which we discussed today. So just go through them once, just try to memorize those, what are in the money, at the money, OTM, what are everything we discussed today, and then we can go ahead from here. Okay, so because this will be used a lot in the future jargons. So that's it. I hope you like this video. We'll connect in the next video. Thank you so much.